What's up, everyone? Welcome to The Money Guy, where we break down the systems that shape your financial reality. If you're new here, hit that subscribe button, because today we're talking about something most people don't want to admit exists. Let's get into it. In 1982, the richest 1% of Americans owned about 23% of all the wealth in the country. Not great, but not catastrophic either. Today, they own 35%, and it's accelerating. By 2030, some economists estimate it could hit 40%. But here's what's strange. It's not because they're working harder. It's not even because they're smarter. It's because the entire architecture of modern capitalism has been quietly redesigned to do one thing really, really well: compound wealth upward. And unless you understand the exact mechanisms of how that works, you're not just losing the game, you're funding the other team. Let's start with something simple. You make money. You spend most of it. Maybe you save a little. You think you're doing okay because you're not broke. But here's the problem. You're playing a game where the rules changed decades ago, and nobody told you. The rich aren't just saving more than you, they're using their money in fundamentally different ways. And the gap isn't about discipline or work ethic, it's about access. Access to tools, to tax codes, to leverage, to information. Things that compound over time in ways that salary never will. So let's reverse engineer this. Let's break down exactly how someone with money makes more money while doing less, and why someone without money works harder and stays exactly where they are. Because once you see the machine, you can't unsee it. Here's how it works. Most people earn what's called ordinary income, wages, salary, the kind of money you trade your time for. And in the United States, that income gets taxed at the highest rate. If you're making $100,000 a year in a high tax state, you might pay 35 to 40% between federal and state taxes. You're left with 60 grand, maybe less. Now let's look at someone wealthy. They don't make most of their money from a paycheck. They make it from investments, stocks, real estate, businesses they own but don't actively run. And here's the kicker. That money, when it grows, gets taxed as capital gains. Long-term capital gains in the U.S., 15 to 20%, half the rate. But it gets better, or worse depending on where you're sitting. If you're wealthy, you don't even need to sell your assets to use them. You can borrow against them. Take out a loan using your stock portfolio as collateral. The bank gives you cash at a low interest rate because you're low risk. You spend that cash, you live on it, and you never pay income tax on it because it's technically debt, not income. Then when you die, your heirs inherit those assets at what's called a stepped-up basis, meaning all the gains you made during your lifetime erased for tax purposes. Your kids sell the stock, pay zero capital gains tax, and the cycle starts over. This isn't a loophole, this is the system working exactly as designed. Let's put numbers to it. Imagine two people. Person A makes $80,000 a year, works hard, saves 10%, that's $8,000 a year. Over 30 years, assuming a 7% return in the stock market, they end up with about $800,000. Not bad, life-changing even. Now person B starts with $1 million. They don't work, they just invested. Same 7% return, after 30 years, $7.6 million. And remember, they didn't add a single dollar, they just let it sit there. The difference isn't effort, it's starting capital. And here's the part that should bother you. Person A paid taxes on every dollar they saved. Person B, if they never sold, they paid nothing. And if they borrowed against it, they got to spend millions without ever triggering a taxable event. Now scale that up. Someone with $10 million becomes $76 million. Someone with $100 million becomes $760 million. The bigger the base, the faster it grows. It's exponential, not linear. And that's why the gap isn't closing, it's widening. But it's not just taxes. The rich have access to investments you've never even heard of: private equity, venture capital, pre-IPO deals, hedge funds. These aren't available to regular people. You need to be an accredited investor. That means you need to have over $1 million in assets or make over $200,000 a year for 2 consecutive years. Why does that matter? Because these investments have historically outperformed the public stock market, sometimes by a lot. If you're already rich, you get better returns. If you're not, you're stuck with index funds, which are fine, but they're not going to 10x your money. Then there's real estate. The rich buy property with leverage. They put down 20%, the bank covers the other 80%, and they rent it out. The tenant pays the mortgage. Meanwhile, the owner deducts the interest, the depreciation, the maintenance. On paper, they might even show a loss, so they pay less in taxes. But the property appreciates, and in 20 years, they own it outright. Rinse and repeat across 10 properties, and you've built generational wealth, all while the tax code rewarded you for it. Compare that to someone renting. They're paying someone else's mortgage, building someone else's equity, and getting zero tax benefits. The game is rigged from the jump. Here's another thing nobody talks about: the velocity of money, how fast it moves. When you get paid, you spend it. Rent, groceries, gas, bills. Your money circulates once, maybe twice, then it's gone. You're back to zero and waiting for the next paycheck. When a wealthy person gets a dollar, it circulates differently. It goes into an investment. That investment generates returns. Those returns get reinvested. The same dollar compounds 5, 10, 20 times before it ever gets spent. That's velocity. That's how you build momentum. And the system protects that momentum. Low interest rates mean cheap borrowing. Quantitative easing pumps money into financial markets. Stock buybacks inflate share prices. All of this benefits people who already own assets. If you don't own assets, you're just watching prices go up and wonder why you're falling behind. So what does this mean for society? It means we're not dealing with a meritocracy. We're dealing with a wealth inheritance structure that looks more like aristocracy, where your zip code at birth matters more than your GPA, where capital beats labor every single time. And it's not just happening in the US, it's happening globally, in the UK, in Canada, in Australia. Wherever you have asset inflation and wage stagnation, you get this same pattern. The people who own things get richer, the people who work for things stay flat. Some call it late-stage capitalism, others just call it math. Either way, the gap is real, and it's not closing because the people with the power to change the rules are the same people benefiting from them. So where does that leave you? Well, you can complain about the system, or you can learn how it works and position yourself accordingly. Buy assets, even small ones. Use debt strategically. Understand tax law. Stop thinking like an employee and start thinking like an owner, because the uncomfortable truth is this: the rules aren't changing anytime soon, and the longer you ignore how the game is actually played, the further behind you'll fall. The rich aren't getting richer by accident. They're getting richer by design. And now you know why. If this video made you think differently about money, do me a favor and share it. Hit the like button, drop a comment with your thoughts, and subscribe if you haven't already. See you next time.